Understand your Medicare? Well, today I'm going to go into our series on Medicaid. Welcome to my channel. If it's the first time you're watching, welcome. My name is Matt Ragudo. I am a chartered retirement planning counselor and have my certification in long-term care planning. And this series today that we're going to dive into is about Medicaid. I get a lot of questions about the differences between Medicare and Medicaid. I got a video up there, and I also have a video out there about the basics of Medicaid and other things in the playlist about Medicaid. But this video in particular, we're going to dive deeper into the financial eligibility for Medicaid. Okay, so first piece of the financial picture for Medicaid eligibility is income. So let's look at the income. Now, in most states, an individual's income, including Social Security, pension, and all other sources of income, must be less than the private pay rate of the facility in order to qualify for Medicaid. And if you needed to look at or look up your state-specific private pay rate, you can go and check or go ahead down to the description below. There's a link down there for you to check. Many states apply an additional restriction that requires income exceeding 300% of the Social Security income rate to flow through a qualified income trust, also known as a Miller Trust. And for 2020, that limit is $2,349. Wait, Matt, we're going into trust? Like, what's going on? Do I need an attorney? Let me explain to you what a QIT is first. So a QIT, or a qualified income trust, a Miller Trust, is an irrevocable income-only trust that holds the income of the Medicaid recipient. Each month, income flows into the trust and the trustee distributes the recipient's allowable expenses. Any funds remaining in the trust after death are subject to recovery by the state Medicaid agency. Most states only require income in excess of the cap to flow through the trust. However, when in doubt, plan conservatively and put all the client's income into the trust. Okay, so that was kind of confusing. If you want more help to your particular situation, you can go ahead and see the link below, fill out the questionnaire, and I can reach out to you if you so require assistance. All right, so let's move into the married couple. So the prior one was if you were an individual applying for Medicaid, and now we're gonna go into the married example. All right, so in the case of a married couple, the spouse in the nursing home, also known as the institutionalized spouse, is subject to the individual rules outlined above. The spouse living at home, also known as the community spouse, is not subject to income limitations or restrictions. If a couple receives joint income, however, 1/2 is attributed to the institutionalized spouse's income for Medicaid purposes. In another video, I will explain what's called the name on the check rule, which kind of goes into a little bit deeper on what they mean here. As a financial planner, even though a lot of us think that because we're married, the income is shared, for financial purposes, for Medicaid qualification purposes, for account ownership purposes, if the account is in just one spouse's name, for the income portion of this rule, that income is treated separate, or that asset that generates income is considered separate for this purpose. And if you go and ask any financial advisor who has your retirement accounts, IRAs, 401k rollovers, what have you, all of those accounts can only be held in one person's name. And that one person has sole control over that account. So I always give this example. I have clients that have, an IRA, 2 IRAs, one for the wife, one for the husband. And what happens is the husband calls and says, hey, I want to withdraw $2,000 from my IRA. And I also want to take out $2,000 from my wife's IRA because, we're gonna go on a trip and we're gonna split it. As their financial advisor and the one who kind of can control or initiates this transaction, I would need either a power of attorney stating that the husband can make such financial transactions on behalf of the wife, or, which happens most times, is I will need to have the wife also contact me or go ahead and jump on the phone with the husband to tell me that she also approves this transaction because they are separate. The next portion is assets. So assets are split into two categories. There is what's called the exempt and countable. So let's go into what is what and what is exempt. Exempt assets are not considered when determining an applicant's Medicaid eligibility. Awesome. Therefore, the nursing home resident and or community spouse can hold onto these assets without jeopardizing Medicaid eligibility. So these assets that are exempt, you can have as much as you want per the guidelines, and it won't count against your Medicaid eligibility. So let's go and see what kind of things we can hold on to and still obtain that Medicaid grant. All right, so your primary residence, one vehicle, personal effects and household items, life insurance, and irrevocable funeral expense trusts. Now, those last two, life insurance and the funeral expense trust, do have that little nice asterisk on them. And what that basically says is each state determines the amount of life insurance and the amount of the final or the funeral expense trust that you can have and still qualify for Medicaid. And if you wanted to go check that, links down below for that information in your specific state. Right, so the second thing we've got to go into when thinking about assets is the countable assets. And this is where a lot of people get stuck on and need a little bit more clarity. So let's go and dive into what the countable assets are for the Medicaid program. Countable assets include any non-exempt resources or pieces of property that hold monetary value and could be liquidated. So that's anything that can be converted into cash relatively easy. An applicant's countable assets cannot exceed a certain amount, which again varies state by state and is different for both the institutionalized spouse and the community spouse. So let's go into a list of the things that they do count and they will count for both the institutionalized spouse, the one receiving care in that Medicaid eligible nursing home, and the community spouse who's living out in the community. All right, so the countable assets include checking or savings accounts, CDs or money market accounts, stocks, bonds, mutual funds, any type of ETFs, anything that's held out in the market, additional real estate, so that's second home, any additional vehicles like a second vehicle, a boat, an RV, land contracts, promissory notes, annuities that have value in the secondary market, and of course, IRAs. Now, for the IRAs, in some states, the IRAs are considered exempt. You can go ahead and check in the description below for those state-specific guidelines. Okay, so now we got the countable and the exempt assets. Let's go into a person who is an individual and what those limits on the countable assets are. So an individual, their resource allowance limit is $2,000 in most states. Now that pertains to the amount of countable assets of a single individual or the institutionalized spouse. This is the amount of money that they can retain while still qualifying for Medicaid benefits. A separate allowance is allotted, of course, for the community spouse. Now the community spouse, their resource allowance, which is also referred to as a CSRA, pertains to the amount of assets a community spouse may retain while still qualifying the institutionalized spouse for Medicaid benefits. Now you can think about it this way: if, let's say, me and my wife, we are both in that stage of life where one of us needs care. I'm in the care home that's Medicaid eligible, and we go ahead and meet someone like me 50 years in the future who says this is what we need to do. I'm just like, well, I've done this before. I'm pretty sure that me as institutionalized spouse, this impoverished me, and then I have no resources. That cannot be done. So because both spouses should take care of each other, they do kind of cap off the amount of income and the amount of assets the spouse in the community can go ahead and have. And this is very important to note, because you can't just transfer all your assets to the community spouse and then impoverish the institutionalized spouse to get Medicaid benefits. They do actually look at both parties, husband and wife, both spouses, when doing the Medicaid eligibility qualifications. So for the community spouse, the allowance again varies state by state, but is generally between $25,728 and $128,640. Now, some states apply a standard CSRA, that community spouse resource allowance, while others apply a minimum and maximum where the CSRA is dependent on the couple's total assets. So, question, what's the main reason why people entering a nursing home don't automatically qualify for Medicaid? Well, that's easy. In most cases, they have too many countable assets and must spend down these assets to become eligible. Some can achieve this quickly by purchasing exempt assets like another car, or by paying off medical debt or mortgage, while others are stuck with a hefty nursing home bill for several months before falling below the asset limit and becoming Medicaid eligible. So there's different strategies. There's also different financial tools that you can go ahead and utilize in order to accelerate that Medicaid eligibility. So in a nutshell, that is the Medicaid financial qualifications. If you want to learn more about the Medicaid program, you can go ahead and click here. If you want to learn about the differences between Medicare and Medicaid, you can go ahead and click there. And please see more videos about both Medicare and Medicaid on this channel. Mahalo for watching. You have a magical day. Bye-bye now.